Welcome to The Explainer. We are jumping right into what's gearing up to be literally the largest initial public offering in human history. We're talking about a target valuation for SpaceX of $1.75 trillion. Just to put that massive number into perspective, that would make SpaceX worth more than every single American defense contractor mashed together. But as you might guess, there's a massive catch to this historic event, and it directly impacts the money sitting right now in your retirement account.
Right out of the gate, we run into this glaring, almost impossible contradiction. If you look at the raw financial reality of the consolidated business we're talking about today, you kind of have to ask yourself, who on earth is lining up to buy a company that's bleeding nearly $5 billion a year and paying a record-breaking $1.75 trillion to do it?
Well, the answer is pretty blunt, and honestly, it might not be what you want to hear. It's you. Yeah, you. Whether you actively want to or not, within just a few short weeks of this IPO, your passive retirement accounts, the index funds sitting in your 401k, are going to be forced to become one of the biggest buyers of this stock. How on earth that's allowed to happen is the real story we're unpacking today. To really wrap our heads around this sheer mind-bending scale here, a $1.75 trillion valuation means SpaceX is aiming to be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. Right? It's huge. To even begin to justify that number, SpaceX has to be exactly the company the public imagines it to be. But if you ask 10 people on the street what SpaceX actually sells, almost all of them are going to give you the wrong answer. Okay, moving to section 1, 3 companies in one. To actually make sense of this wild valuation, you have to realize SpaceX isn't just selling rockets to Mars. It's really 3 distinct businesses stacked together in a trench coat. And when we break down the actual revenue, the part of the company everyone knows, the rockets, only brings in about a quarter of the cash. The vast majority, 61%, comes from a totally different venture called Starlink, while the rest is tied up in a recent, highly controversial acquisition. Let's look at the rockets first, since, that's what's painted on the side of the building. They launch satellites, cargo to the ISS, and run crewed missions for NASA. Last year, that rocket business generated roughly $4 billion in revenue. Now sure, $4 billion sounds incredibly impressive in a vacuum, but it completely fails to justify a $1.75 trillion valuation on its own. Not even close. So if launching rockets isn't footing the bill, what is? Enter Starlink. This is absolutely the crown jewel of the operation. It's essentially a satellite internet provider. Think Comcast, but beamed from space via 10,000 satellites orbiting the Earth. In 2025 alone, Starlink brought in $11.4 billion in revenue, boasting over 10 million active subscribers across roughly 150 countries. But the most mind-blowing part is its explosive efficiency. Just 2 years ago, profit margins were at 41%. Today, they've accelerated to 63%. It's literally the fastest scaling telecom company in human history. So here's the rub. How does a company with a literal cash printing machine like Starlink end up losing money overall? That brings us to the most complex financial side of the business, xAI. This is an AI lab Elon Musk founded to compete with OpenAI. A few months ago, SpaceX acquired xAI in an all-stock deal that valued the AI lab at $250 billion. But here is the reality check. xAI was burning more than $1 billion a month. And by March of this year, every single one of its 11 elite co-founders had walked out the door. The company literally had to be rebuilt from the foundation up. SpaceX effectively paid $250 billion for an asset starting completely from scratch. When you stack this up against established heavyweights, the picture of intense overvaluation just jumps out at you. OpenAI generates around $24 billion in revenue and is valued at $850 billion. Anthropic brings in over $30 billion and is valued at $400 billion. And then you have xAI, estimating just $1 billion in revenue, but scooped up for a staggering $250 billion. As our source notes, the market is pricing xAI like it's Emirates, but in reality, it's operating a lot more like Spirit Airlines. It's basically the reverse Jerome Powell of SpaceX. Instead of printing cash, it just burns whatever the rest of the business manages to generate. Section 2, the $5 billion reality. Look at the actual balance sheet, and you'll see Starlink and the rocket business actually performed phenomenally, printing roughly $8 billion in profit. But because of the massive cash burn required to rebuild xAI, the consolidated company of SpaceX ended up losing nearly $5 billion last year on roughly $18.5 billion in revenue. So we're back to that massive contradiction. Why are you going to be forced to buy this at a record valuation? Which brings us to Section 3, changing the NASDAQ rules.
To understand how a company deep in the red actually pulls off this kind of valuation, we need to look under the hood at the hidden plumbing of the financial system, specifically the NASDAQ 100. This index is the absolute gold standard for growth companies. It's tracked by more than 200 investment products controlling over $600 billion in assets. The thing is, once a company is included in this index, it basically forces every single investment fund that tracks it to automatically buy that stock. Getting into the NASDAQ 100 is like unlocking an automatic fire hose of billions of dollars in passive investment capital. Now, under the old rules, getting access to that fire hose took some time. You had to wait 3 months just to allow for market price discovery. You also needed at least 10% of your shares available to the public. But on May 1st, right before SpaceX's targeted June listing, NASDAQ quietly rolled out the red carpet with 3 highly convenient rule changes. First up, the fast entry rule compresses that 3-month wait down to just 15 days. Second, the 10% minimum free float requirement was completely wiped out, which is absolutely vital here since SpaceX is only targeting a 4 to 5% float. But this third rule change, it is absolutely the most shocking. It is a hidden multiplier for companies with a free float under 20%. Under this brand new rule, NASDAQ now treats a small float as if it were 3 times bigger than it actually is. So, that means a 4% float gets legally weighted as a 12% float. What this means, in plain English, is that we have literally engineered manufactured demand. ETFs and passive funds are now legally required to buy 3 times as much of this stock as they normally would have to based on shares that aren't even trading. And that leads us to our final part, Section 4, your 401k as exit liquidity. So how exactly do all these abstract listing rules actually hit your wallet? It all comes down to who is actually being sold these shares. Normally, in an IPO, about 5 to 10% of the offering is allocated to everyday retail investors. But SpaceX is doing something completely unprecedented here. They're targeting a massive 30% allocation for retail buyers. And the CFO of SpaceX explicitly told a room full of bankers exactly why. It wasn't for price stability, nope. It was because, in his own words, retail buyers are incredibly supportive and loyal to Elon. They are dumping 30% of the largest IPO in history directly onto retail. I want you to really let this quote sink in from portfolio manager George Noble. He says, your 401k is the exit liquidity. You see, the buyers and sellers in this IPO do not show up at the same time. The buyers, your passive funds, are forced in early thanks to that fast-tracked 15-day rule and the manufactured demand multiplier. The sellers, the early insiders who are sitting on massive profits, are unlocked later. The shares move from insiders directly into the retirement accounts of everyday people, who end up absorbing them at an absolute peak $1.75 trillion valuation. You know, passive investing was sold to all of us as this ultimate triumph of common sense. Low fees, easy diversification, set it and forget it. It sounded great, but there is a very dark side to that convenience. Because the exact same mechanism that makes passive investing so easy is the same feature that makes you a guaranteed automatic buyer for anyone who can change the rules to squeeze their way into the index. So I'll leave you with this final thought to chew on. If the system can automatically force you to buy an unprofitable $1.75 trillion company just weeks after it lists, what else is hiding in